Well, good morning. This is Dean Tenney. I'm coming to you from my studio here in fabulous Las Vegas. I've been trying to add more content to the channel for Series 24s and 9s and 10s and even 4s. It's been just going into our second year and was trying to populate the YouTube channel with stuff for our new folks. So there's not as much viewership for 24s and 9s, 10s, and 4s, but you folks have been very supportive of sending your newer human capital to the YouTube channel. I want to have something for you. And hopefully, if we can add something for you, you'll continue to refer those newer folks to the channel for the SIE for help with the SIE, their Series 6 or 7, their 65 or 66. We have two narrative lectures so far on the channel for Series 24s. We have one on net capital fiscal responsibility. We also have one on market making and trading. And so today's installment will be investment banking and research. I'm trying to keep these in over an hour. These are supplements. So, if you join me for a 2-day Series 24, obviously we're going to spend a little more time on this than we're going to spend on a YouTube channel as a supplement. Anyways, let's get started. So types of underwriting commitments for test purposes. Now, when Dean says for test purposes, that means outside of the test. That might be different than what I'm telling you, but inside of the test, that's pretty much what it is, right? Series 24 fantasy land. At least once you pass, you get to leave Series 24 fantasy land. I'm stuck here permanently. Now, in a best efforts underwriting, my broker dealer was called Gamma Global. And on the banking side at Gamma Global, by the way, it's Gamma after Vasco da Gama, the Portuguese explorer, not Gamma. But anyways, I say Gamma Global Investments will extend its best efforts issuer on your behalf in raising these funds. My broker dealer is not willing to commit capital to the deal. However, we will act as your agent. So in a best efforts underwriting testable point, the broker dealer, the investment banker, is acting in its agency capacity to the issuer. And, typically in this kind of a deal, it's going to be a contingent deal. And what we mean by that is it may or may not take place depending on, whether we can fulfill what are called the escrow terms. One time I was involved in a deal and, we have that escrow account, very testable. We can't break the escrow account until we fulfill the terms. And every once in a while, somebody would say, well, Dean, why doesn't your broker dealer just, top off the escrow account? Let's break escrow and get busy. I'm sorry, that's not allowed. I'd be acting in my principal capacity. But one time I had a guy who was looking at the escrow account. He said, Dean, it looks like you're kind of close. I go, well, I guess that's your definition of close, right? And he said, I like the scale of what you're doing. And he says, what do you think? I'm thinking about, I'll just, write a check and take that thing and top it off so we can get going, break escrow. What do you think? And I said, well, before I tell you, Gary, what I think, I want to tell you what my relationship is to you. I'm not your agent. I'm an agent to the issuer, my broker dealer is. And it's very unlikely I'm not going to tell you to do exactly that. In fact, I think you should do that, but you need to understand that I'm representing the issuer. I'm not representing you in this transaction. Now, in a firm commitment, by the way, there's no liability to the broker dealer in a best efforts deal. In a firm commitment deal, there is going to be a risk to the broker dealer. Sometimes we call a firm commitment deal an open contractual commitment. Now, as far as the issuer is concerned, the stock is sold. Sometimes we refer to this as a bought deal. A lot of people forget that the Facebook IPO, the Facebook IPO at $38 a share was a firm commitment underwriting, a bought deal. And, that means that the issuer, the managing underwriter, the syndicate of the managing underwriter syndicate in this example was Morgan Stanley, and the Series 24 that was in charge of tech banking is a guy named Michael Grimes. And they told Facebook they were going to get them $38 a share. Yeah, and that IPO stands for it's probably overpriced. I'm joking. It stands for initial public offering. Was wobbly. And, it didn't look like Zuckerberg or, Cheryl were concerned about it. And they said, well, as far as we're concerned, that stock is sold at 38. The way we understand a firm commitment, open contractual commitment, a bought deal, that's Morgan Stanley and the syndicate stock at 38. And what they do with it is their problem. How is their understanding? Their understanding is very, very good. Now, remember, as an open contractual commitment, we're going to buy whatever stock we can't sell. And so that means we may end up with an inventory position in the stock. And so we take haircuts on inventory positions, and the haircut on an inventory position that results from an open contractual commitment is 30%. Remember, there's only certain types of broker dealers that are allowed to engage in firm commitment underwritings. So it's going to be a 30% haircut. Please note that the Facebook went from 38 and went as low as 19 in the aftermarket. And, Reg T prevents us from lending money to customers who want to buy new issues. New issues, I would know, are non-marginable. Another way to say that same thing is that they're ineligible for purchase in a margin account. It's considered a new issue 30 days from the effective date. So, you say, I say, Dean, are you going to be able to get me a IPO allocation? I said, I doubt I'll be able to get you an IPO allocation, but hey, if we don't, we can step into the secondary market and buy it there. And they say, okay, well, let's do that. If we miss the IPO allocation, let's go into the secondary market and buy it there. And let's do it in my margin account. I say, no can do. No can do. Now, another problem we may have is that nobody's going to want to buy our Facebook stock at 38 if they can buy it in the open market at something less than that. And so in the Facebook example I'm using, that issue is stabilized. Now, stabilization can only be used, I think of stabilization as a legal form of pegging. Pegging is when you are using your own resources to keep a stock at a set price. And in almost every other scenario we would be discussing a legal form, pegging, it would be illegal. But stabilization can only be used for firm commitment underwritings. And it can only be done by one member of the syndicate. Sometimes we call that member of the syndicate a stabilization agent. I forgot to set my little clock here. I'm trying to keep us under an hour on these things. So let me set my little egg timer. Firm commitment, one member of the syndicate. And to prevent us from making this thing look like it's hot rather than it's sticky, not test terms, but in the industry, we use hot for, stuff we don't have a problem selling. We're taking public at 38 and it's trading at 50 or 55. That would be a different situation, testable situation called withholding. Sticky is just a colloquial term for one that we can't seem to get rid of. So it's got to be at or below. At or below. What happened here? At or below the public offering price. So, we're not supposed to give the impression that it looks hot when it's actually not. So we got to put in our stabilizing bid at or below the public offering price. It has to be in the prospectus. And better to have it in the prospectus and not need it than need it and not have it. So as a matter of course, we're typically going to say, the issue may be stabilized in a firm commitment underwriting. I'd be interested in your thoughts in the comments. I respond pretty quickly to comments or questions. I've been trying to chunk stuff instead of narrative lectures sometimes. It just dawns on me, maybe this would be better as a bite-sized chunk on firm commitment underwritings. I've done both in the 7. I've done narrative lectures and then, little bite sizes of shorter lectures on certain topics. Let me know your thoughts on that. Because, maybe I could just put a little presentation up on firm commitment. All right, well, moving on with our discussion here. I told you about stabilizing bids. I didn't realize I had another slide there. By way of review, it can only be done in firm commitment underwritings. It can only be entered by one member of the syndicate. This would be the one time we don't have a two-sided quote. It'll be transparent. It has to be in the prospectus. Better to have it in the prospectus and not need it than need it, not have it. Michael Grimes, after the Facebook offering, it was at 38, 38, 38, 38. If you were my client, I'd tell you to sell it. But anyways, he said, listen, the syndicate spent $200 million stabilizing Facebook. Again, that's meaning keeping that stock at 38 because nobody's going to buy the stock at 38 if they can buy it at 34, 32. He said tomorrow we're going to remove the stabilizing bid and it will find its natural price. And hence, poof, once we make the distribution and we break syndicate. By the way, breaking syndicate is up to the manager. And once the manager, in this case, Morgan Stanley, breaks syndicate, then we decide in a firm commitment underwriting how much of that stock belongs to you and is inventory, and you're taking that 30% haircut. So exempt transactions, 33 says you're going to sell brand new securities to the public, that you have to, make an S1 registration statement. And for follow-ons S3s, and so you're not going to do that here. So they're going to say, SEC says, why didn't you do it? So Rule 147 is a safe harbor under 33. So the SEC says, Dean, why did the issuer not make a registration statement? I said, well, we're using one of the safe harbors available under 33. And one of those is an intrastate offering of securities. Now, the testable distinction between 147 and 147A, they're almost identical, except 147A allows you to make offers in multiple states. And the other test question about an interstate offering is that we have an 80% test. 80% of the funds raised have to be for an issuer within the state. 80% of the revenue, their assets. I would just know it as the 80% test. I wouldn't get too in the weeds on, revenues and assets, but that's what that means. And then all the purchasers have to be residents of the state. And then after a resident of the state has held it for 6 months, they can sell it to a non-resident. Reg A plus, I wouldn't imagine you're going to see this because Reg A plus has been raised. There's 2 tiers on this, and tier 1 and tier 2. And I don't think you'll see anything on it because they recently raised it to 75 million. And typically what they do when they change rules is they remove it from the Q bank, the question bank of the exam, and then reintroduce it later when it's updated and been tested for validity. But that's another safe harbor available to us. One that I would be aware of is Reg S. Reg S is a U.S. issuer. Pay attention to anything that's internationally flavored because that's been showing up on the exam quite a bit. So Reg S is a U.S. issuer selling or issuing securities offshore. Goldman Sachs does a lot of this where they have a global presence. They have offices around the world, and this is a U.S. issuer issuing securities offshore to foreign institutional investors. And the test question here is this is all this stock, but this particularly is unregistered under 33, unregistered under 33. And whenever we have unregistered securities under 33, that means those securities that we're issuing offshore outside the US are going to have to remain offshore for 6 months. That 6 months is kind of a typical kind of a time frame. Pipes. Pipes are private investments in public equity. And I would expect you to get a couple questions or perhaps a question on pipes. This is where an institutional investor goes to a public company and buys a stock directly from the issuer. And again, those shares would be unregistered. And so what they would do is then hold them and register them and hope to make a profit as a result of this private investment in a public equity. Not always, but sometimes these transactions, private investments in public equity, a public company, are done by QIBs. And I would definitely know what a QIB is. A QIB is a qualified institutional buyer of securities. And they have the definition of that is they have 100 million in assets under management. And the idea here, the good thing about being a QIB is you would be allowed to buy unregistered foreign and domestic securities. That's the upside of being a QIB. In my social media, I like to post questions. Unregistered foreign and domestic securities. Current events, and I was reading where, SpaceX has raised a lot of money, $3.8 billion over the last 48 months. And, my question to my social media people was, what was most likely used? What exempt transaction? And by the way, I wrote the question before I actually knew the answer. And I thought for sure it was going to be a 144A as the exemption that SpaceX, a privately held business, is using. But come to find out, it was not a 144A deal. It was actually a Reg D. So, so much for what Dean thought the answer was going to be, All right, so let's see. So here we go. Reg D is very, one of the major exemptions available, one of the major safe harbors available to us under 33. Or exempt means a safe harbor means we're not registering these securities with the SEC. And so under 506B, we can have up to 35 non-accredited investors. And that means in the 506B, we can't advertise or solicit. We can have an unlimited number of accredited investors and institutional investors, but no more than 35 non-accredited investors. And that means we need to know what the accreditation standards are. Accreditation standards, whether you can accept an invitation into what we call a private placement. We call these private placements of securities. These are, securities offered by invitation only. It would accept the invitation. It looks like I kind of blew that there. Let me get rid of this. Eraser, boom. Veritas will know what the accreditation standards are. And the accreditation standard is $1 million net worth. That's exclusive of your personal property. I want you in my Reg D private placement. You say, Dean, I don't have $1 million net worth. I say, do you make $200,000 for the last 2 years with the expectation of that this year? You say, no. I say, are you married and filing jointly? Do you make 300K? I think a good way to remember this is 1, 2, 3. 1, 2, 3. $1 million net worth, $200,000 annual income, 300 if you're married and filing jointly. And a recent addition to this is a Series 7 or 65 in good standing. Be careful on this. This has been showing up. I haven't had any debrief. It's on the 24 yet, but it's been showing up on other exams. It doesn't surprise me because, all kinds of people are misinterpreting the SEC's expanding definition here and thinking if they go get a 65, which does not require sponsorship, they're accredited. No. Good standing means you're considered accredited if you're Series 7 or 65 affiliated with either a broker dealer or a investment advisor. So this doesn't mean you stand alone, become accredited, assuming you fail the accreditation standards. Now on 506C, we can't have any non-accredited investors. All we can have is accredited institutional investors. By the way, 506B was the one SpaceX used, which was surprising to me. And I think they used 506B because there were individuals participating, would be my guess, but what do I know? Anyways, 506C, no non-accredited investors. Now, the neat thing about that, though, is you can advertise. You can solicit. Boy, I come from the dinosaur days, and it's still shocking to me when I see listen or see or watch an advertisement for a private placement. It just blows my mind. But it's allowed. Now, typically what you're going to have to do, though, is you're going to have set up what's called a data room where you have access to the documents. And before somebody can access the private placement memorandum or the offering documents, they have to verify, or you, the broker dealer, need to take action to verify that you indeed have every reason to believe they're accredited. 504 is an exemption. We can't raise no more than $5 million there. And just because, you know, we're exempt from 33, there's still some paperwork required. The SEC wants to see a Form D for these offerings within 15 days. And FINRA, this is recent, but FINRA wants to see a copy of the private placement memorandum. This marketplace has been really, you know, expanding dramatically. And I told you about that access to the data room. You know, you just can't let anybody have access to the data room. You have to do some qualification of that prospective person before you allow them access to the offering documents. Exempt from registering securities as a result of. So, you know, there's certain transactions that are going to be exempt from registering, you know, securities. You know, one of those would be reorganization. Whoop. Let me get on my thing here. Oh, for example, Facebook has reclassified themselves as no longer being Facebook, right? They're now Meta, and Facebook is a subsidiary of Meta, and that does not require them to register the securities of Meta. You know, most of these rules are about equity, so this doesn't apply to debt. This is the point. So I told you the reclassification is, you know, this idea about we were, you know, Facebook and now we're Meta, and do we have to, you know, re-register that? And the answer is no. Now, another one that we are going to have to register, I'm just checking my notes to make sure I'm telling you what I want to make sure I get done in this brief period of time that we have. Oh, one more other point. Good news, I checked my notes. I knew there was something else I wanted to talk about. It doesn't require registration for stock dividends or stock splits. Now, we are going to have to register the securities if it's a result of, you know, a consolidation or a merger. I'm going to get too hung up on investment banking, but we have what are called triangular mergers. And a triangular merger means there's three parties involved. You know, we're going to have, for lack of imagination, I'll call it NUCO. And then we're going to have company A. And we're going to have company B. And, you know, NUCO is a company we set up to tender for the securities of company A and of company B. And so what we're saying here is that this, let me get out my drawing tool, that this NUCO securities, these securities are going to have to be registered. So if we are issuing securities for a merger or acquisition, that does require the securities to be registered. Another example would be Disney used its shelf registration to issue securities to pay for Fox. They said to the Fox shareholders, how about X number of shares of Disney? That's called the exchange ratio. I wouldn't worry about it. But anyways, that would also require those securities to be registered. And indeed, the Disney shares were registered using their shelf, which we'll talk about in a little bit. Fairness opinions. A lot of times there are going to be fairness opinions involved. And, you know, a fairness opinion rendered by the investment banking firm, the broker dealer, we have to disclose our existing relationship with any of the parties concerned and who we represent. There might be more than one. The board might get a fairness opinion, the outside board, whoever. And then what we're being compensated for rendering that fairness opinion. Public offerings with a conflict of interest. You know, sometimes this stuff is not in English. It's not in plain English. And what that means in plain English is a self-underwrite. For, what, 100 something years, I guess, every 2 years, the partners at Goldman Sachs would take a vote and say, all in favor of continuing the partnership for another 2 years, say aye. And for a long time, Goldman Sachs was publicly held. And then the managing general partner said, listen, before we take the vote, partners, about continuing our private partnership called Goldman Sachs, if we say no, if the partners say no, let's no longer continue the partnership, the next vote that would follow would be, should we reorganize as a C Corp and go public? So partners, 2 votes on top of each other, potentially 1 vote, because if we vote to stay private, well, then we won't take the second vote. But, if the first vote about continuing the partnership says no, partnerships have a finite life, the next vote that will follow immediately is whether to reorganize as a C Corp and go public. And, the partners voted and they decided to reorganize as a C Corp and go public. Now, when Goldman Sachs is going public, what do you think Goldman Sachs thinks they're worth? So, partners, I think we're worth 5 times book. But, when you're doing a self-underwriting, you have to have an independent qualified underwriter to determine the price. And this example with, Goldman, they use Lazard. Lazard is going to be the independent qualified underwriter that is going to be, involved in determining the price. Now, this is not required for a follow-on, because in a follow-on, remember, there's going to be a public marketplace. And so Goldman Sachs doesn't need to have an independent qualified underwriter involved in a follow-on underwriting, a follow-on in that case. No surprise, you do for mama, mama does for you. So when Lazard went public, guess who their independent qualified underwriter was? It was Goldman Sachs. I don't want to send out negative vibes, negative testing vibes, but to be honest with you, bankers and traders don't struggle as much on 24s because this is something that is more familiar to them. If it's been, when I lose somebody, when I do a 2-day class with, 20 would-be series 24s, many, many classes, everybody passes. But when I lose somebody, not many, but 2 or 3, the things that were most frustrating to me is nobody really blows it completely. I mean, very rarely does somebody just, blow this. I mean, when they miss it the mark, they miss it by 1 or 2 points. And typically it's somebody who's been a long time since they got their 7, because that's natural, right? You develop your niche and then you go doing what you do. And the other thing they have in common is they do package products like, mutual funds and variable annuities, things like that, and aren't as familiar with these areas. Now, the other guys, the men and women who come from the banking side, trading side, they struggle with, retail stuff, IRAs and correspondence. But, unfortunately, that's not enough to do those men and women in. So, I'm just, there's a reason I chose to do as our first 3 installments, trading, fiscal responsibility. And here we are doing underwriting. So just giving you a heads up. All right. So assuming we don't have a safe harbor available to us or an exemption available to us, we're going to do the traditional 33 thing where we're going to file an S1 if we're a U.S. Issuer, F1 if we're a foreign issuer like Alibaba or somebody like that. And then we're going to enter into the quiet time or cooling off period. The quiet time or cooling off period. And that quiet time or cooling off period is a minimum of 20 days. Now, so if I'm a broker and we are in the cooling off period and you call me, I'm supposed to say we're in the quiet time or cooling off period. I'm not allowed to comment on the prospects of that issue. What I can do is send you a preliminary prospectus, also known as a red herring. And that has pretty much everything you need to make an informed decision, except the final offering price. Now, we typically have a window there where we think we're going to be able to get for the stock. Veritas will know what we can and can't do as a supervisor. I think 24 is kind of like babysitting 7s, right? And so what my brokers can do is send out a preliminary prospectus known as a red herring. Based on that, Veritas, we can accept indications of interest known as IOIs, which are non-binding on all parties. Is, you know, I say, you can put me down for an indication of interest on 1,000 shares. That's non-binding on the customer. It's non-binding on the broker dealer. It's non-binding on the issuer. And so it's non-binding on all parties. Now, based on those indication of interest, we're going to have a pretty good idea of whether IPO stands for instant profit opportunity or whether IPO stands for it's probably overpriced. You know, based on these indications of interest, we're going to know whether we're going to be worried about withholding or stabilizing. And we're going to know based on that window of prices that we have in our preliminary prospectus, whether we're going to be on the high end of the window or the low end of those windows of that pricing, you know, between 12 and 20, whatever the case is. You know, if I have more indications of interest in the stock I'm offering, well, then I'm going to jack up the price. You know, if I have less, maybe I'm going to be on the lower end of that window and maybe I lower the price. And so we enter in the cooling off period. But by the way, you know, some people never make it out off the cooling off period. We went into this cooling off period, never made it out the other end. And then they were blaming their underwriters, JP Morgan and Goldman Sachs, which I think is a little ridiculous because, you know, they know this process. And, you know, they said, well, listen, going public is there's certain things that are required. Now, what we're supposed to make sure we do is we make no omissions of material facts. I saw this broker being interviewed and they asked him why he didn't tell the customer this information. He said, I thought I'd lose the sale. You know, that's a terrible answer. I can't think of a worse answer, right? And then there's two nasty words we never use in the securities industry. We never use the word approve and we never use the word guarantee. You know, on the front page of every prospectus in big, bold, black letters, it, you know, says, well, sometimes even different color. The SEC neither approves nor disapproves of any securities offering. They neither pass upon the adequacy or the accuracy of the information contained herein. Any claim to the contrary is a criminal offense. So, you know, making a fraudulent distribution of securities to the public is going to be a big, big, big problem. So let's see. I think I want to just point out one thing I think I skipped over. Let's see if I got it in this next slide. I didn't. I just want to go back here real quick. And the reason I want to go back here is because in a firm commitment underwriting, let's assume it is hot. And I have a good customer who says to me, Dean, oh, I'm Goldman Sachs and it's Fidelity. And Fido, that's what Fidelity is commonly known on as the street, Fido. Fido says, hey, listen, Dean, instead of 2 million shares, I want to bump it up and I want 3 million shares. And so good news, I have what's called a Greenshoe, where I can expand the deal by no more than 15%. So what that allows me to do is say to Fidelity II, and I'm going to give them another 1 million shares. So if I'm offering 10 million shares, I'm going to have access to another 1.5 million. And what I'm going to do is just short that to Fidelity and then tell the issuer I'm exercising my Greenshoe. We call it a Greenshoe because the first corporation who used it was the Greenshoe Corporation. So anyways, just want to circle back and make sure I got that into this little introductory banking lecture. That's where we're at right now. Okay, well, we just because we are exempt or have a safe harbor available with the SEC, you know, I think of the SEC is God and state administrators think they are. So there's these 50 demigods running around. And just because we've registered the security with the SEC does not mean we can sell it in the state of California or Nevada or Michigan or New York. If it's a traditional IPO where we're doing an S1, we're going to have to coordinate that. Coordination. And that's when we're registering with more than one entity, the SEC in the states. And we're going to have to coordinate that with the various state administrators. We have this, what's called the North American Security Administrator Association. These are called and referred to as blue sky. Say, have we blue skied it in California? Have we blue skied it in, Texas? That's what that term means. So we would coordinate at the same time we're going through the SEC registration with the various state administrators. Now, if it's an exempt issue, we can't coordinate. And so, for example, I brought up a 147, which is a state deal. And that one, we're not going to register through coordination because we're not doing an SEC registration statement. And that one, we would have to do what we call qualification. No, we asked the state administrator, what do I need to do to sell this 147 in your state? And what do they say? I say, aye. Now, I wouldn't get too in the weeds on this, but we also have what are called federally covered securities, where we don't have to worry about running afoul of what's called the Uniform Securities Act. Okay, so listen, what would you rather read, a prospectus or a research report? You'd much rather read a research report. You know, Mary Meeker has left the securities industry and left to go become a general partner at a venture capital firm called Kleiner Perkins. But before she went to Kleiner Perkins, she was in charge of research at Morgan Stanley. And when she was in charge of Morgan Stanley tech banking, she was known as Queen of the Net. If anybody wants to know about what's happening in the internet space, Mary was the go-to research person. Most of the stories have a point, so be patient with the story. Anyways, Frank Patron works at Credit Suisse, and Credit Suisse is taking Amazon public. Credit Suisse is underwriting and taking Amazon public. Everybody thinks or wants to know what Mary Meeker thinks of the IPO of Amazon. Morgan Stanley, that's where she's the head of research, is not involved in this underwriting. And so while Credit Suisse can't do any research, because if they had research, we know it'd be a buy recommendation, nobody would read the prospectus. So in my example, Morgan Stanley, it's in the normal course of business for Morgan Stanley and Mary Meeker to be commenting or, following the internet space. And so we would expect that she has something to say. So there's no prohibition for a non-distribution participant. And what does that mean in English? Somebody who's not involved in the underwriting to publish research. And she came out with a strong buy. Woohoo! We love that, right? Because when Mary says buy, you read her research report, that's what you'd rather read, than the prospectus. No human being has read a prospectus. Attorneys read them, but, anthropologists aren't sure if they meet the definition of human beings. I'm joking. Listen, it drives me nuts when people don't use legal counsel when they should, because, you want to make sure. I'm reading Michael Dell. I highly recommended his memoir of Going Private with Dell. And, the first thing he did, which I thought was very smart. Now it's easy for him because he has resources, but he called a major law firm and said, listen, I don't want to run foul of anything. So, I want to make sure I got some good legal counsel. And the partner said, I'm going to send this guy to you. He's expensive and he's going to be with you through this process. And, Michael, in his little vignette, comments about how much stuff he wanted to say, but his attorney told him to keep his mouth shut. So anyways, Mary can publish research on this. Now, we better make sure there was no consideration paid. In other words, what we're saying here is the participants can't, give Morgan Stanley consideration payment for that. Now, I can publish research on non-equivalent securities. So equity and debt are non-equivalent. So what we're saying here is that if I'm underwriting the equity, I can comment on the debt. I can publish research on the debt. In fact, I could say, well, this equity will help the debt. For example, I'll use Morgan Stanley again. I don't know if this is true, but, Tesla is, selling stock. And so, I'm underwriting stock for Tesla, and I can talk about how this might help their debt, their balance sheet. Or if I'm issuing debt, I'm selling debt for Tesla, I can talk about how that leverage, that gearing might help the equity. And those are non-equivalent. That's perfectly acceptable. Now, the testable point here is that there are securities that are considered to be equivalent. And the equivalent securities, on this test, you got to believe in human depravity and original sin. And what I mean by that is, if there was not rules, things will be running amok. Convertible bonds, you can see where if I were clever, I could publish research on a convertible bond and stay focused on the conversion price, which really is a discussion about the stock. And so equity and convertible bonds are equivalent. And what that means is I can't publish research on the stock while I'm underwriting a convertible or vice versa, are equivalent securities. Follow on or additional public offering. So if we're doing a follow on, then, if it's actively traded, we don't have any of these rules. I shouldn't say any of the rules, but there's a lot less rules for securities in which we are doing the follow on. And in the follow on, I just want to make sure I got my notes here. It's going to be 10 days where we're going to be prohibited from publishing research. Sometimes we refer this not testable is a booster to get the shot there. Distributions. Okay, there we go. And we said if it's actively traded, we don't have to worry about that. Okay. If you're a WKSI, a well-known seasoned issuer of securities, you have a 3-year shelf and it's immediately effective. So, no news is good news. You just notice to the SEC. I kind of give you a good example of this. This is what Disney used to pay for Fox. It's better to have the securities on the shelf and not need them than need them and not have them. So as a matter of routine, a WKSI will have a shelf, and they don't need to have it on the shelf because they can just immediately file it. And it's called taking down the shelf. So for a 3-year, the test questions, potential testable topics here are, what is a WKSI? I told you Disney is, let's define that. 700 million on public common equity float, $1 billion in debt issued in the last 3 years. And the testable point is their shelf registrations are good for 3 years and they're immediately effective. Most of the time you can't take down the shelf unless you can give the SEC a heads up and they might say, yes or no. Anyways, not yes or no in terms of approval, just, saying, well, listen, we'd like some additional information. Sometimes the SEC will send you a deficiency letter. For example, Hertz had a shelf. They're not a WKSI. And they tried to take down the shelf and the SEC said, really, while you're in bankruptcy, why don't you consider this a deficiency letter? We'd like more information about this before you proceed. Anyways, what was I going to put here? Oh, make sure you understand that's immediately effective. In English, what that means is, Disney is good to go. They can just issue these securities to pay for Fox. Well, who better than your peers to decide whether or you're an investment banker or whether you're engaged in, fraudulent activity? So the corporate financing department of the will look at FINRA will look at this. The information is going to be filed with the manager, and they're going to look pretty subjective, look at what's considered unreasonable compensation. And, the way I would suggest you proceed, excuse me, on this type of question is what I call the Sesame Street trick. One of these things is not like the other. And so, they give you 4 choices. You go, wow, that just stands out to me as being obnoxious. 10% of the money raised, 10% of the equity, rights and warrants. And so I would use the Sesame Street trick in answering this question. There are certain transactions that are exempt. And, if they say they don't want to hear from you, like, we know you're legit, they might say you don't have to file. And that helps them focus their efforts on people they should probably be looking at. You say, Dean, it must be so cool to work at a broker dealer and get first dibs on all the good stuff. I said, well, actually, that's not so. I'm a restricted person. If we didn't have rules about restricted persons like myself, you would never see the good stuff because we'd keep it for ourselves. And so restricted persons are associated persons with the broker dealer, immediate family members of the broker dealer, fiduciaries to the broker dealer, accountants, attorneys, finders, those kind of folks, are restricted persons. This rule does not apply. This rule does not apply to our, our own underwriting. So if Goldman's going public and the employees of Goldman's would like it, no problem. That's good. That you want to eat your own cooking, so to speak. This rule does not apply to friends and family of the issuer. If the issuer says to give the stock to somebody, somebody can have it. Here, maybe I have, let me put this up here, an undisclosed investment entity. So I'll use Andy Kessler. Andy Kessler used to work at Morgan Stanley with Mary Meeker. That was a kind of a legendary team, and Andy left and set up a hedge fund called Velocity Capital. I don't know who are the limited partners in Velocity Capital. And it's unlikely Andy's going to tell me who his limited partners in his hedge fund are. And so de minimis. So I want Andy says he would like an IPO allocation. I'm Morgan Stanley. We're taking Uber public. And Andy, he's semi-retired, I think now, but let's assume, my story is true. Not all my stories are true, based on truth. But let's assume he wants a Uber IPO allocation for Velocity Capital. I say, listen, I know you probably have some people there that are restricted. It wouldn't surprise me if there are Morgan Stanley people that are in his hedge fund. De minimis is Latin, so it's so small, who cares? And so I say, Andy, do you have anybody over there who is managing money? Just a sec. I'm going to pause this for just a sec. My signal just went. Pause. Okay, so anyways, I say to Andy, do you have anybody over there that owns more than 10%? He says, well, no, but they own less than 10%, but they are restricted, can't exceed 10%. I say, Andy, do you have carve-out procedures in place? And what I mean in English there is, if I give you the IPO allocation, do you have accounting such that you can make sure the restricted persons are not participating? Again, it's by kind of a binary thing. He says yes or no. I say, Andy, I need you to sign a representation letter to me that we've had this discussion. Now, once we get this on file, we have to have it on file 12 months. This is to prevent from what's called spinning. Spinning is where I'm putting, stock into accounts where I think it can do me the most good. And so, to prevent me making IPO allocations to Andy thinking, okay, I'll get some trading business from him if there's a quid pro quo, right? I say, you do for mama, mama does for you. I'll give you this IPO, and you should do some trading with me. No. So we have to have this letter on file 12 months preceding this transaction. And that first one has to be what we call positive consent. That's what I mean by he has to sign it. And then every year we're just going to send it again. And negative consent just means, we're reminding that we're holding this representation letter in your account on your behalf. So that's what's going on there. Okay, reporting done by the issuer. We're going to have a 10K. The 10K, one of the testable distinctions between a 10K and a 10Q is that's audited. And it's audited by a public accounting peekaboo firm, a certain type of accounting firm. Due within 90 days. 10Q, you can get 3 of those. And remember, what's included is the balance sheet, the income statement of cash flows, a minimum. 8Ks testable or for material current events. And they also can be used to cure a violation of Reg FD. So Reg FD means no whispering, full disclosure FD, but no whispering. Chairman Levitt's one of my favorite all-time chairmen. And, he has a book called Taking on the Street. All the rule changes that are a direct result of his tenure. 24 used to be pretty easy. I'd say, join me Wednesday, Thursday, test Friday, no pre-study, no post-study, 125 questions. And then, we had some problems. As a result of those problems, we beefed it up to 150, did some more trading questions on there. So it became a little more. So anyways, maybe I'm a general counsel. I'm not an attorney, but let's assume I am. I'm a general counsel. You're the CEO. You're talking to one of our institutional investors, and you say it's going to be a difficult 12 to 18 months. And then you hang up. I said, well, you blew it, man. You can't tell the institutional investor that and not tell our retail shareholders. There's no distinction between our owners. I'll file an 8K to take care of it. So 8K within 24 hours. Reed Hastings took on the SEC, wanted to, but his general counsel said, forget it. He went to Facebook and said they would cost 1 billion hours of streamable content. And the SEC said, well, that's not the appropriate disclosure location. It should be the Edgar site of SEC. And he said, really? I got more people on Facebook than AK. So they've revisited this for the past. I thought for sure when Elon has made a couple tweets that were, I thought, inappropriate. What do I know? I thought for sure that Tesla would file an 8K within 24 hours to take care of this thing about the Saudi prince and taking Tesla private. Uh, 13D is for when you cross 5%. And 13D, again, I'm reading Michael Dell's latest. And, 13D is filed by Carl Icahn when he owns more than 5% of Dell. You're going to file that with the market center, New York or NASDAQ. You're going to file that with the issuer, and you're going to file that with the SEC. Uh, 13G, so let's just put this here, active investors. And 13G is for passive investors. That'd be like Fidelity or, BlackRock or, somebody like that. I just told you who you report to. I would definitely know who you report to. Market Center, Issuer, SEC. Rule 144. You can't solicit 144 buyers. So as a broker dealer, I'm not supposed to call you and say, hey, this is founder stock. This is stock in Facebook that was once owned by Zuckerberg. Total misrepresentation. Now, if you call me, the broker dealer, and say, Dean, if you have stock coming off restriction, because remember, 144 stock is typically unregistered stock. And there's rules about how much of this unregistered stock you can dump into the public marketplace. I think of Rule 144 is how we turn unregistered stock into registered stock. And you have, as a customer, expressed previous interest to me within 10 previous days, then I can say, hey, I do have some stock, 144 stock coming off restriction. Now, if it's a member, remember, that's another broker dealer. So there's this thing called FINRA, and then we have FINRA member firms, right? You're taking the 24 because you want to be a general securities principal of a FINRA member firm, and that would be 60 days. So 10 for customers, 60 for another broker dealer. You say, Dean, I know you took the company public. I know you're an axe of the stock. Axe is the colloquial term for somebody who's very active in the stock, responsible for, large amounts of transactions and knows where the float is, so to speak. An issuer buying its own securities. Well, a lot of issuers have the resources to manipulate their own stock, and they're not supposed to do that. I just read where Microsoft has the board's last meeting decided to authorize a $60 billion repurchase. They've authorized Microsoft to go into the open market and buy back $60 billion worth of its stock. So, Microsoft trades on NASDAQ. Microsoft would have to go through one market maker or designated market maker. They can't exceed 25% of the average daily trading volume. They can't mark the opening. I can't call, my market maker and say, hey, let's start every day with an uptick. Let's end every day with an uptick. No, so we can't mark. That's called marking the opening or marking the close. Can't be the first trade of the day. Can't trade in the last 30 minutes. And I can't tell my market maker, well, listen, I'm looking at the highest bid at, 153. Let's make it 154. No. So issuer buying its own securities. The point is the issuer can't manipulate its own stock price. Tender offers, non-equivalent securities purchases are okay. So if I've tendered for the stock, I can buy the bonds. A tender offer has to remain open for 20 days. If we change it, we have to leave it open for 10 more days. And the target company has to tell us in 10 days what they think we should do, whether we should tender the shares, for example, on Fox. Fox tells you where you should tender your shares to Disney, or we think you should reject the tender offer. Research conflicts with investment banking. Well, I told you this is one of the major changes that were made. I'm getting older, so recently to me, decades to most. But we had a huge problem. And one of the before we have these new rules we're about to discuss, the bankers would tell the research analyst, they'd say, listen, if I say that's an $80 stock, that's an $80 stock, and I don't care how you get there, but you need to get there in terms of evaluation. I was joking about legendary Mary Meeker, and Morgan Stanley bankers would say, Mary, what we need a higher valuation. She says, well, I can't get there. I said, well, then I'm probably going to go public with somebody else. And I said, well, right. So one of our favorite example, or one of our, infamous examples I would suggest was Smith Barney and Sandy Weil had told his analyst, Jack Rugman, it's embarrassing that, I sit on the board of AT&T and you've got a sell recommendation. Why don't you look at that with a fresh set of eyes? What does that mean? In an emails are captured. He said his friend told his friend, if Sandy said, if I change it, that, he would get my kid into this preschool. Anyway, so now the investment bankers, I'm protected as a research analyst. I have separate supervision from the investment bankers. I have separate compensation. I can't be compensated on banking deals anymore. In Jack Rugman's case, he's making $20 million a year. And as a retail Smith Barney customer, you might think that's because, he tells you what stocks to buy and sell and represents you, when in fact, he's representing WorldCom, for example. They disclose ownership, can't trade 30 days before or 5 days after the issuance. It's hard to believe. It's embarrassing sometimes when we need rules like this. Can't trade against my own recommendation. Again, we captured emails of research guys saying, can you believe I'm recommending this? I'm actually short the stock myself. Ugh. We have to have a quarterly record of public appearances to make sure that what they're saying, analysts are saying in public, matches up or is reconciled with what we're saying in the published material. We have to disclose investment banking business 12 months prior to research, and expected investment banking business 3 months after. Come to find out, Dan Reingold, who was the telecom analyst at Merrill Lynch at the same time Jack Rubman was at Smith Barney, said, man, I don't know how he nails the earnings to the penny. I work very, very hard and I don't even get that close. I think he might have material non-public information. We'll come to find out, him and the guy named Bernie Ebbers, who was running WorldCom, were having a scotch and, writing the research report together. So now I can't give editorial control of the research product to the issuer, but I can ask them to verify my data set, my facts. There's the quiet period I told you on research, 10 days following the IPO, 3 days for a follow-on. As I mentioned, there's an exception for actively traded securities. All right, woohoo. So it looks like I brought this in, I think, at my target of under an hour. Make sure you like, you subscribe, comment. Join me for a 2-day class if you'd like on 24. I also do 24 tutoring. That's available for you if you need that. If you have people just starting their journey into the securities industry with their SIE, their Series 6, 7 top off, or their 65, 66, we appreciate referrals to the YouTube channel. And I'll be beefing up. I apologize for the how long it's taking to get more 24 stuff available, but it will continue to leak out here over the next 3-4 months. Same for the 9 and the 10. We're going to continue to kind of beef up what's there available for senior people with the broker dealer. Okay, I'll see you on our next installment.